So this is the second part to the video of today, which is about passive monitoring. So again, what was passive monitoring? So passive monitoring basically involves exposed assessment of what you've seen. So essentially you might think of this as taking a picture of the firm as you observe it today, and based on what you see today, decide upon whether you think actually management did a good job. So you makes an intermediate assessment typically before actually the final results of projects have been gathered. But is the firm on track? Is the firm doing well? Based on that, you make your assessment of how the firm is doing, and you actually remunerate management based on that intermediate action. So you might think of market prices doing their job. So lots of investors actually trying to figuring out how well a company is doing, and tying actually performance remuneration, performance compensation to the management to what the market signals is the state of the firm. We might also sort of think of credit rating agencies, which, well, again, take a view of what does a company look like today. They take a picture of the company, as it were, and based on the outcome of that picture and of their assessment of that picture, which is costly, management will get or not get compensated. So when does this happen? So after the choice of effort, of course, an exposed signal that you get of how well the company is doing. But before the project outcome is realized, because one project outcome is realized, the only signal that is relevant that we have is the outcome itself. So was it R or was it 0, essentially, in our model? But in this case, we assume that there is some sort of signal, some early indicator, and this is an indicator of the health of this company and also of the likelihood of the project being successful. So to illustrate this using an example, so consider the old days, essentially, when spices were traded through ships, and so ships were sent from Europe towards, for instance, the Far East. So in the Netherlands was the East India Company which did this, and of course there was no Suez Canal route, so these ships were sailing past the Cape of Good Hope, which is down there in South Africa, where now Cape Town is, of course, towards the East Indies to take valuable spices on board there and travel back, and making, once they reached the Dutch ports again, making a nice profit for the merchants there. But of course this was a risky business, and many of these ships actually didn't make it. So now imagine you are sort of investing in this ship, and you would like the shipping company to do a good job of finding a good crew with a good captain to make sure that at least this ship has a good chance of making it all the way there and back again, although of course still there might be some mishaps. There could always be a storm which this ship cannot endure. But there is this early signal that you can have, because you can see when this ship is on its way to the Eastern Indies, you can see whether it actually reaches the Cape of Good Hope before that. So what would you do as an investor? You might actually send an observer to the Cape of Good Hope. And this is the observer, as you can see, and she is constantly on the lookout whether this ship that you have sponsored as an investor, whether that ship is actually on track and whether it's actually passing Cape of Good Hope after, say, 3 months' time, because that would be a good signal. Then at least the ship has shown the competence of its crew to some extent. At least they've managed to get as far as Cape of Good Hope, and it will the observer here, this monitor, will then send back a message to you. Oh, everything looks all right. We have good information on this ship. It's on track towards the East Indies. If they see the ship, of course. If they don't see the ship, this is bad news. Doesn't mean the ship's lost, but might mean she just missed the ship. It was night when the ship passed. or the ship might come as is a bit delayed, it will only come a month later, but it would be a bad signal. So this is basically the setup that we have in mind here. We have this intermediate signal. Does the ship pass the Cape of Good Hope? After 3 months, well, if we see this, well, then that might be a good signal, but no perfect signal of welcoming the ship back in a year time with the valuable spices. So let's look at this in terms of a model. So I'm the investor. I'm making this investment I in the ship, and the company itself, the management of the company is hopefully doing its best in finding a good crew, but they might actually also skimp on that and find a cheap captain with a crew which is often drunk perhaps, and which is a lot cheaper to get on board, and that will be the no effort case, and in that case the company earns the private benefit. So that's where our moral hazard is. So do I find a good crew with it, which raises chances of a good outcome, or do I find a crew on the cheap, which actually gives me as a manager private benefits B, because it's costs me less effort and it's less costly in terms of wages. Now, what's the effect of this effort choice? Well, if there's a high effort choice, so the upper branch over here, then of course in the end we might have a higher chance of success R, so we'll still call actually that success of after effort, the success rate after effort PH, and the success rate after low effort PL. But now this PH and PL, they're broken up in constituent parts. Because the first thing that we'll see when effort has been done is, do we get this early good signal? Do we see the ship passing the Cape of Good Hope? So we're going to assume that when a good crew has been found, so when effort has been spent in finding a great crew for our ship, then there's a large probability of seeing the ship on time passing the Cape of Good Hope. And this intermediate probability, we call this sigma with a big H, because that's a high effort, and a little h designating the high signal, a good signal. We see the ship passing Cape of Good Hope. Of course, the management could have spent effort, so high effort, but still the signal is not so good. So we don't, in other words, see the ship passing the Cape of Good Hope in 3 months' time. So that's called sigma HL, and you can imagine this will be exactly 1 minus sigma HH. So we either see the good signal, ship passes Cape of Good Hope in time, or the bad signal, no mention of the ships by our observer who's sitting there. Now, if we get this message, yeah, everything looks all right, we've seen the ship passing Cape of Good Hope, then you update, of course, the probability that this whole mission will be a success. You'll update this probability to a value nu h. So that will be higher, of course, than your initial success probability pH, because you already have seen, well, the first part of this trip has gone quite well. So there's a higher probability actually now that we will have success. If on the other hand we get a bad signal, so we don't see this ship in time, and still we might have missed it, or it might still come, but the probability of success now drops a bit to nu L. Similarly, if the bad crew was selected, so no effort was spent by the management, then the probability of success will be sigma LH, so low effort, but still, might be that out of sheer luck, this crew still reached Cape of Good Hope, so our observer sends out the message, oh yeah, we saw this ship passing, so we get a high signal, a good signal, and after we've seen the ship passing Cape of Good Hope again, everything seems fine, and we update our probability of success to nu h. Or indeed, and that's now more likely, when the low effort has been spent, the probability that we do not see the ship passing Cape of Good Hope in time, so the low signal, that is sort of now more likely. So sigma LL, this probability is going to be now a bit higher. Still, even though we haven't seen the ship, it might still succeed, and we might still see our crew and our ship returning with the spices after a year, but with only a probability nu L, which is lower. So this is the sort of extended tree of possibilities that we have in this model. So let me reformulate those pieces of information. So we have the signal, so the ship passing the Cape of Good Hope, and basically what happens when we see the signal, we will update how likely it is that the project will succeed after a long time, after a year, or perhaps even after a couple of years, that the ship will come back with the spices, and we'll update it to a high value, new H, or low value, new L. And the signal is informative. So if we see the ship, that's informative that this is going particularly well. So if we see the ship, we update our probability to a higher value than we would have ex ante had we only known that effort had been chosen to in selecting the crew. So this new updated probability is a bit higher than what we had before. And similarly, if we don't see the ship, we are even worse. We have even worse expectations than if you only knew that the crew was bad, because they might not even have made it until the Cape of Good Hope. So with high effort, we get this high probability sigma HH of a high signal, of the good signal, passing Cape of Good Hope. And yet still, even when there's a high effort, so a good crew has been selected, capital H, there might be a low signal. That's a complementary, probability. And it must be so that ex ante, so at the moment the ship is leaving the port in Amsterdam, it must be so that the expected signal of eventual success, so making R at the end after a year, conditional on having chosen a good crew, that still is pH. So if you walk through this tree, this probability tree, you'll see, well, this can happen in two ways. Sorry, let me go to the tree here. So one way of getting a good outcome after effort is having a high signal and then indeed having the final success R after a year. That probability of this is the probability of the first getting the good signal, sigma HH, times getting new H, the probability of after passing Cape of Good Hope you will actually reach the Indies and get back. And similarly, if you do spend the effort, you might have a bad signal, so we somehow missed this boat, but still there's some probability that we still have success. So those are the two constituent parts after effort of still making up for this final outcome R. So that's basically what these two parts here reflect. So those two probabilities together would still be pH, to make the model comparable to what we had before. So completely likewise, if the management spends low effort, so has a worthless crew, still there might be high signal, so even these people might be lucky and they reach Cape of Good Hope in time. But this is just less likely now, so sigma L of a high signal, so after low effort getting a high signal, that's a bit lower than before, and likewise converse with sigma LL. And also we have a similar relationship here. We might still be successful even with a bad crew. Okay, so that's the summary of this tree of events. So we have the early signal, and the idea will be we cannot, or we don't want to let, it's not going to be optimal to let the firm, the entrepreneur, wait until the very end, so after 1 or 2 years, with paying out based on whether the ship has returns. It turns out to be optimal to already remunerate the entrepreneur when we see the high signal rather than the low signal. So we're going to make the payment to the entrepreneur. We're going to make that conditional on seeing the early signal rather than on welcoming the ship back at the end. And we'll see that this will actually raise pledgeable income. So using this early signal of success already as a date of remuneration, a moment of remuneration for the compensation for the entrepreneur. So we're going to look actually at 3 cases, most extensively the first case, free monitoring. So let's assume hiring or having this person at the Cape of Good Hope is actually not costly, not very costly. The second will be a designated monitor, so we'll have to include the fact that we have to pay. Somebody has to pay for this monitor. And thirdly, we'll have a quick look at market monitoring. So with free monitoring, there's no cost of hiring this the lady who is sending us this information from the Cape of Good Hope. The optimal contract, as I just mentioned, will reward the entrepreneur, the management, for effort based on the signal and not based on the final outcome. And of course, this hinges on the fact that putting in more effort will raise the probability that the ship will reach the Cape of Good Hope in time in the first place. So it increases the probability of this high signal. So the probability of having a high signal after high effort will certainly be higher than the probability of getting the Cape of Good Hope with a lousy crew. So what we'll do in this remuneration contract is to say, well, entrepreneur, I'm going to pay you this RB that we will agree on whenever I get a message from my observer at Cape of Good Hope that we see the ship in 3 months' time. And all the remainder of the risk will be for the investors. So the only payment to the entrepreneur will happen after the 3 months rather than after the 1 year when the ship comes back. So only based on this passing signal of the Cape of Good Hope. So let's have a look now at what this implies for the incentive constraints and for the participation constraint for entrepreneur and investor. So what I'll do is go again to the paper to write those down. So here we are on paper. So we have to again look at incentive compatibility for the borrower. So what does this borrower get? Well, if the borrower, the entrepreneur, spends the effort, they will get the payment RB. Well, when? Well, if the signal is good, right? So what was the probability of a good signal after high effort? I call that the sigma, right? The probability of a good signal after high effort. So high effort and a high signal, a good signal. So we spent a lot of money, a lot of effort on selecting the crew, and as a result, we get a good signal, hopefully with a good probability that this ship is actually passing the Cape of Good Hope. And in that case, the entrepreneur gets their RB. Now, this happens if I'm the entrepreneur and this is what I get in expectation. If I do spend effort, and of course incentive compatibility should make sure that this outweighs what I get if I spend low effort. Well, if I spend low effort, I might still get lucky and still my ship, in spite of my low effort, might get the high signal of passing Cape of Good Hope in time, and well, that will make sure that I get my payment, right? So then I get my RB still, but with a lower probability. But of course, again, if I spend less effort on selecting the crew, I have to pay them less, and I can get away with the difference in the fees that I need to pay, or I just have to spend less effort in selecting this crew. Anyway, for me, there is some private benefit. So for me to be there, for me as an entrepreneur, for there to be an incentive to spend the effort, again, it's of a similar form as what we've seen before, but now what we worry about is the probability of getting the good signal rather than the good outcome, contingent on my spending effort or not spending effort. So of course, this translates into a constraint on RB. It needs to be big enough to make sure that spending effort is more attractive to me than not spending effort. So this is the incentive compatibility constraint. So now we may ask, well, what's now the expected minimum payment that we need to pay, RB, that we need to pay to the entrepreneur as investors? Well, the RB min itself is exactly this amount, B over sigma HH minus sigma LH. It's the minimum we have to award to the entrepreneur, so the expected minimum payment. Well, with what probability are we paying this RB? Well, when we see the good signal. And if indeed the entrepreneur does spend the effort, which happens when this RB is at least as big as RB minimum, will then be sigma HH, because that's the probability of getting this good signal and hence paying out this RB times RB min. Right? So this is the expected minimum payment needed to be made to the entrepreneur to give effort. And more is of course okay, but this should be at least this big. So that gives us information about the pledgeable income, of course, because what's the total pledgeable income of doing this project? Well, the expected final outcome, which is for the investors ultimately, after a year, conditional on effort by the borrower, by the entrepreneur, is of course again PHR. That's the outcome of the total project, given that there is effort. And I have to subtract from this the expected minimum payment that I need to make to the entrepreneur, which is this bit. Right? So when can I finance this project? When can this project get financed by outside financiers, outside investors? Well, whenever this expected pledgeable income is bigger than the funds that are required to get the ship running, sailing rather. So this is a condition now, and for this the ship to be financed, this project to be financed. So again, this gives us an A bar, which is the difference between these 2 points. So we have to compare this with a case in which we ignore all these interim signals and just pay on the basis of whether after a year this ship comes back. And this comparison, of course, is our original model was PHR minus PHB over PH minus PL. So if we ignore the information from this passing of good hope and just pay out at the end if the ship comes back, then this was our necessary condition for having this ship financed. So the question is, which of these 2 are better? So let me go back to the slides to address that. So there we are. So let's look back. So we had this entrepreneur incentive compatibility constraint. So the entrepreneur gets paid if the signal is okay, rather than if the ship comes back. So that was basically this compares the probability of getting the high signal with or without effort, and that gave us this incentive compatibility constraint. And then expectation, the minimum payment that we need to make to the entrepreneur to make sure that there's effort was this amount we saw. And so the participation constraint, or rather the financing constraint for this project is, well, assets has A for the entrepreneur have to be at least as high enough to make sure that indeed the pledgeable income here exceeds I minus A, like we saw. So we are comparing again here. So the upper formula here was what we had in the original model of week 1, if you wish, where we had pledgeable income just based on payment at the end, whether the success or no success, 0. Whereas now we are looking at this interim signal, which is informative, where we pay out based on this on whether the ship has passed Cape of Good Hope, and this gives us the new form, the new participation constraint where we have replaced the pH divided by delta P, pH minus PL, with the sigma HH, so the probability of a good signal, divided by the difference between the probability of a good and a bad signal. So now when is the second constraint more advantageous. So in other words, which A bar is going to be lower, so which one will make it more likely that we can finance this enterprise? Well, as long as the original ratio of these probabilities exceeds this similar ratio, but now only for the signal, then the signal is going to add value. Why? Because then this second pledgeable income expression will be higher. And now the point is, and we'll actually check this in the tutorial, that this is actually always the case for the conditions that we gave. So this pH over pH minus PL is always going to be higher than sigma HH divided by this difference between the probabilities of a good signal. And the intuition for that is that this signal, does the ship reach the Cape of Good Hope, is more closely, more intimately related to the effort choice ex ante, so to the fact of whether a good crew for the ship was selected. It's more direct measure of this effort than the final outcome. And the reason is this final outcome will be dependent on lots of things that happen after the ship passing the Cape of Good Hope, or after realizing this good signal. What happens afterwards is, of course, no longer dependent on the initial effort choice, but it's essentially an additional piece of noise that contaminates the view that we have on the hidden actions that were taken by the entrepreneurs. So by focusing on an earlier signal, we get actually a cleaner signal of whether effort has been taken. So there's less noise in what we observe, and that makes sure that actually there's a better observability of what the actions were of the entrepreneur, and we get therefore a lower cost of the moral hazard. So this way, passive monitoring based on these intermediate signals is going to be valuable in the sense of raising pledgeable income. So far we assume that the information was free, so this lady at Cape of Good Hope was working for nothing. Well, of course, that's not always, or often actually not the case. So somebody has to gather information, and that's costly. So whether it's a shareholder that's sort of monitoring the actions of the company, or a bank that has their analysts taking actions to see, or a credit rater take actions to follow this company, that's costly business. They have to do a lot of work to work out what direction this company is taking, and whether we see good or bad signals. It's not just up for grabs. So there's now two possibilities. So either investors can hire somebody, so designate a monitor who is going to do this on their behalf, and they are going to pay this person as an analyst to analyze the firm. And the second one is we can rely on speculators. So we can hope there are some people in the market who hope to make a profit by trading on the information that they have, by buying stock if they see good signals from the company, and selling stock when they are getting bad information on how the company is doing. They will earn money. They will try to earn money at least by trading on that information, and then by looking at what's happening to the stock prices, we make our deductions as sort of outside investors, whether indeed the company is doing well or not. So let's have a look at either of these. So in the first case, you can think again of these bank analysts. You can think of these credit raters, who are actually hired. They get paid, right, to take a look at how the company is faring today. They take this intermediate signal picture of the company, and they don't know yet whether the ultimate projects will be successful, but sure, they will spend effort, hopefully, if they are motivated to do so, to find out as much as they can based on the currently available information. So, of course, we need to compensate these monitors, and we have to make sure that they have the incentives to figure out how the company is doing, what the health of this company is. So they have to incur some cost. The cost is C. This monitor is designated by, say, by the investors, or perhaps even by the firm itself, and they need to be compensated in a way that actually makes it incentive compatible also for the monitor again to do the work and to figure out a truthful signal of how the company is doing. In this case, one way of compensation, you can read about it actually in the book as well, is giving the monitor stock options. So if you give a stock option to the monitor with a strike price equals to PHR, well, that's precisely the expected value, right, of the company if the management does do their efforts. So that's worthless from the point of view of outside investors who expect the entrepreneur to do their work. But if the monitor does her actions, gathers her information, sends this observer to the Cape of Good Hope, at that moment in time, the monitor can update their information on whether this project is likely to succeed. And when they observe the high signal, from their point of view, their updated probability of success is going up to a new age. In that case, it's going to be attractive for these monitors to actually exercise their stock option, because the intrinsic value in that case is going to be higher, and if the option expires at that moment, it will be a good thing for them to actually exercise the option and get stocks at the strike price PHR, which from their point of view now have increased in value to new H times R. If on the other hand they don't get a good signal, then it will not be smart for them to exercise the option, because then they will have downgraded their views of the company to a new LR, which is going to be lower than PHR, so they will not exercise the option. So in this case, whether or not this monitor is going to exercise their option is going to be a signal of whether they actually observed the good signal, or whether they did not observe the good signal. And we, as outside investors, we can see whether the monitor is exercising their option. This gives us a reliable point of view of whether the monitor has updated their views on the company, so whether they have seen the good signal, in other words. And if we see this happening, well, then we pay out the entrepreneur based on the good signal. So this is one way in which we can incentivize the monitors to actually give a truthful signal of whether they've seen the good signal or the bad signal. So the other alternative to this, so to designate somebody to monitor, is just to rely on anybody in the market. Lots of people are investing in the market, are traders, speculators, and they are following these companies. They can buy the signal in terms of spending their efforts in following a company and following the industry in which this company is active. And when they see good signals, they will buy the company, driving up prices. And when they see bad signals from this industry, from this particular firm, they will sell their shares or even go short in this company, and it will typically lower the stock prices. So the movements of the stock prices should be sort of an indication of whether these speculators have gathered good information or bad information on this company. Now, if you think about this, there might be a problem there, because these speculators, they are trying to earn money by spending some effort and spending their own money in gathering information. But if you see such a speculator who's starting to buy a share, then you see, oh, this person who is doing their best to figure out how well this company is doing, they are trying to buy a share, so obviously they have got good information. And all at once, all the market sees this buying order, and everybody updates their beliefs based on this buying order for the firm, and they will only be willing to trade. If the speculator wants to buy, well, then their information must be good. So I only want to sell if the price that they're willing to pay has gone up to new HR. So in the end, no trade occurs. These speculators cannot actually gain, they cannot benefit from all the effort they've done, because the mere fact that they've come into the market to buy is already raising the price. So, well, this is a conundrum. So there's no benefit here of spending any effort. So what can we do about that? Well, it's a solution here. So people still do this. So why can they do this? Well, if the investor is really small with respect to the rest of the market, they might be able to hide among lots of other trades and are not informed. So if there's lots of uninformed trades, not informative trades, so people who buy or sell stocks for completely different reasons, because they need liquidity at this moment, for instance, or because they're rebalancing their portfolio without any intrinsic information on the stock. Well, then actually, if you are sort of the speculator who does spend a lot of effort in following this company, you do have some good information, then in a sense you can hide your own orders for buying this trade in the large amount of noise. The noise traders, they are actually called, these people who trade without any new information. You can hide your trade in the noise trades by these other investors, and you can still make a benefit. You can still make a profit and earn back all these costs that you made in investing in following this company and getting the information, the reliable information. So this is basically the way out, the reason why actually trade does occur and information gathering does occur and can be profitable. So that's what market monitoring does. So following share prices to see how well the company is doing might be a good strategy, and therefore, based on share prices, remunerate the entrepreneurs. That's a good way of exposed monitoring the effort choices of the entrepreneurs. So to wrap up this lecture, so we first looked at active monitoring. So there we had this ex-ante monitor who reduces the scope for the entrepreneur to engage in moral hazard. So they reduced the capital B, private benefits capital B, to a smaller value, little b. And we had to make sure that this monitor actually has an incentive to do his or her costly work. And secondly, now we just looked at passive monitoring, which relies on some interim signals, interim snapshot of what is this, how is this firm doing so far, and making sure that the entrepreneur gets paid based on these interim signals rather than then the final outcome of the project. We saw that this is going to increase pledgeable income. So next lecture, we'll have a look at this model of passive monitoring, or in particular this model of early signals. And we look at not only at remuneration, but we actually look at control. So who's going to take actions rather than just paying money after observing low or high signals. So that will be the topic of next time. See you then.